Hey guys, welcome back. In today's video, we are talking about the shorts liquidity crunch, how they need to cover up, the need for collaterals, and many more in this video. Firstly, and the best part of these videos is taking a look at how apes have continuously bought more shares of AMC. You can see here is a slow, steady climb to 10,000 AMC shares. After today's purchase, new total at 1,678. Another user, every day I buy more in honor of my ape family. 4.5 years of fighting corruption together. AMC business is set to explode, and you can see another buy order. Now, the reason why I update this and try to do it on a daily is because we've known by now that the data that we gain access to are very likely to be fabricated by these institutions. When you take a look at FTDs, we know that those can be faked. We know that those can be resetted. So we don't know truly how many FTDs exist out there. When you take a look at the short interest, we've known that the short interest is also self-reported. So we don't truly know what the short interest for AMC is. Multiple examples when you take a look at the dark pool, which we talked about recently, how even the dark pool data that we're seeing could not actually be correct. And we're still looking at the minimum. We're still looking at way less than where it should have been. And so with all of these data that is given to us, when we already know that they are not real, we have to understand what is actually happening. And these posts are pretty much the very indication and confirmation that apes have never left AMC, and instead they're continuously buying into AMC. And so for us, it's the biggest understanding of how we are supporting the business, of how we're fighting these short sellers. And that's why we try our best to obviously update this on a daily. Like I said, you don't have to share all of your information, but when you see another fellow ape and they are buying more shares, and you can feel free to obviously support them, and it's just good to let the community know where we are standing. But now let's take a look at this. So Ken Griffin says American economy is doing well, and you can see Samuel's translation. Ken Griffin is heavily exposed to carry trades. A rising Japanese rate and falling US rate could flip profits into losses, trigger margin calls, and spark a broader liquidity crunch. So we've already talked about this in terms of the Japanese yen carry trade. Now, like we've said, it isn't just going to affect Citadel, but actually it's going to affect the market as a whole because multiple institutions are involved in this. However, our focus is of course into Citadel because we know just how heavily affiliated they were with these yen carry trades. And so with this that's happening right now, with everything that's going on, we know that we can be expecting massive volatility, and for these institutions who are heavily exposed to obviously see their position trigger margin calls, see their positions going to heavy losses, and therefore spiking a liquidity crunch will affect multiple short sellers that are also out there. We've already talked about the financials of Citadel. We've seen their shorts, we've seen their positions, we've seen the derivative positions, and so this is just one of the many that's already added on top of what we've just talked about. But you can pretty much see right now how these short sellers are not in a good position, how all of these short sellers and brokers, like we've said, have all put themselves in the positions we've warned everyone 4 or 5 years ago, in terms of too much leverage, too much exposure, not enough liquidity to cover these margin. And at any point, whilst on the surface it looks good, but any point, any given moment, the moment something, even the smallest thing that goes wrong, it could all trigger into mass margin calls. And that's what we are seeing right now. You can also see how banks are trying to cover up the fake fabrications that they've also created. You can see here, reverse repo at the Fed, aka cash on the sidelines, have been slightly increasing ahead of Q3 end. This is a very typical window dressing move from banks before an important snapshot of their liquidity. I expect the RRP to fall down to 0 in Q4. So the reverse repo, like we've said, the easy access of liquidity for these short sellers is something we've been keeping a close eye on this channel. And what we've seen, and you guys can see on this chart as well, is how it's been dropping. And last week, or at the start of this week, we saw it at 13 billion, but yet as we're closing off, we're seeing it at 25 billion. Now, does this mean that suddenly they're going to be injected with another lifeline? Of course not. We have to remember, we saw the reverse repo go all the way up to 2.4 trillion. So whilst 25 billion is a lot of money, when you compare it with 2.5 trillion, it's obviously nothing. And so it isn't going to save them from the positions they created when they had the access to 2.5 trillion. But what this is is the quick injection of liquidity for them to make their financials look good, for them to, on paper, to make themselves look like there are no distress, to make themselves look like they are all doing very well. We've seen them do this plenty of times in the past. Like we've said, one of the other tactics used by these banks is that they don't close out their losing positions, but they close out their positions that's in profit. So when they release their financials, it says they're in profit, but when actually net, they're in losses. It's just that they haven't closed those positions. And so those open P&L aren't actually being reported. And this is just another way for them to make themselves look like they are doing fine. But we know with everything going on in the market right now, it's obviously not. You can see multiple examples, even here. The Buffett indicator, we are seeing how it hits 220%, meaning the stock market is valued at more than 2.17 times the size of US economy. That's way higher than the dot-com bubble peak. Now, there's obviously things to take into consideration here. Firstly, the economy is a lot bigger now than it was back from the dot-com bubble. So it is without a doubt, there's going to be more money involved. But this isn't the only thing that we've seen. We've seen recently how multiple firms have been shown that they are way above their valuation. We're seeing so many overvalued stocks out there. We're seeing how even massive CEOs are talking about the potentials of bubbles, especially with the heavy investments into AI. And so we're really looking at how the market is very, very shaky right now. And just like I said earlier, we are just one tiny thing away from a massive crash in the market. And the reason why we're talking about this right now, maybe normally it's not relevant, but when you take a look at the examples we just given, especially when we talk about how Citadel can be at risk of mass margin calls, we're seeing how the Fed are obviously trying to inject money to make themselves look good. You know, we're seeing also the massive crash that could also happen with the Buffett indicator. These are all indications of where the market is at right now. And any signs of showing massive market crash, showing any signs of liquidity, collaterals being drained out, it's all signs of showing the squeeze happening for AMC and GME. Because ultimately, these shorts rely on the market going up for them to actually have the money to continuously short AMC, to continuously create synthetics and continuously finance their short positions. And so when we see all of this go away, you can imagine what will happen to these positions. Another example, US recession alert. US heavy truck sales 3-month moving average dropped to 438,000, the lowest since the 2020 crisis. And once again, these aren't relevant normally. When you just take a look at one of these factors normally, you may think, okay, that's something to look at, that's something of a warning, but it's not something major. But given everything that we've just looked at, which are all unrelated to one another, but all directly related to the health of the economy, we are seeing what's happening in the market right now. And so that's why in times like this, we're seeing how they're trying to create liquidity. All of this comes down to the fact that institutions need money because they rely on the market going up so they can use it as collateral, so they can use it to suppress AMC. They need this liquidity. And you can see how brokers are trying to do this as well, where we're seeing be careful of FINRA's motivation, as we're seeing that Hood and FINRA allowing more leverage could wreck a lot of retail traders because the 25,000 minimum equity rule mandates traders must maintain a minimum account balance of 25,000 in a margin account. Now, the FINRA is replacing this mandate with an intraday margin rule that applies the existing maintenance margin rules to intraday exposure. In other words, one's intraday buying power will be based on the margin requirements for the positions they take on during the day, not a fixed equity minimum. So what we are seeing is how they're trying to increase the liquidity in the market. Now, bear in mind, the liquidity that they're trying to put into this market is for the sake of bringing the market even higher. Linking back to what we've just said. The institutions, the shorts, they need the market to go up. And as we're seeing this rule change, which is with the intention of putting more liquidity in the market to bring the market up higher, you're seeing how we're seeing the institutions are realizing this problem right now. They're trying to allow these brokers, allow these institutions to get another lifeline. But this time, they're doing it directly with the cost of retail investors, and as they're trying to remove these rules. Because remember, this $25,000 rule isn't going to affect any institutions. The ones that are generally affected by these rules, and I think even 100% of the time, is the retail investors, it's the retail traders, because these institutions will not be stumbled on by a $25,000 minimum equity rule, right? They are management with hundreds of millions at the very minimum, so they won't be affected by 25,000. So this is what they're trying to do by putting retail and injecting their money into the market to allow these institutions to have another lifetime to prolong these whole things. And so we can see how they need the collaterals. We can see how they're trying to cover up the fakes. We can see the liquidity crunch happening right now. And that's why the shorts are panicking. Now, as always, this is financial advice. So do take advice. If so, make sure to do your own due diligence and research. And I'll catch you guys next time.